Okay, everybody, we're going to get started with our webinar, Police Presentation 457 Plans, How to Supercharge Your Retirement. Now, I'm going to stop sharing my screen for a minute. I want to introduce myself. I'm Chris Engelbert with Engelbert Financial Advisors in Allentown, Pennsylvania. Everybody that's registered for today's webinar that didn't register for our webinars number 1 and number 2, every new person that registered for our webinar is going to get a copy of our book, Financial Planning and Retirement Strategies for Pennsylvania Police Officers. It's something we have available on our website, but as soon as we're done with our webinar, we're going to send it out to you in the mail, so you'll get it in the next couple of days. So I'm going to go back to sharing my screen right now, and we're going to get started in just a minute. You should be seeing my screen that says Engelbert Financial Advisors, Police Presentation 457 Plans, How to Supercharge Your Retirement. So this is the third in our series of webinars. The first one that we did back in February was your defined benefit pension plan and all the ins and outs of your defined benefit pension plan. The second one that we did in March was all about DROP and how it's the second most valuable resource that you could have, retirement benefit that you could have. Today is all about the 457 plan. Now, when we get done with this series of webinars, we are going to be posting them on our website under a tab for police officers so that you can go back and watch them. Also, if you registered for this webinar, you will be getting a link to this webinar as well that you could forward to other fellow officers. But we're trying to make our website, Engelbert Financial Advisors, a resource for police officers where you can go and watch all of our 3 webinars. Now, just to give you a preview of what we have coming up sometime in the fall, we're going to run these series of webinars again, but we're going to have guest speakers this time to add their insight into defined benefit plans, your pension and divorce, and also labor negotiation with regards to pension. So that's what we're planning for the fall third quarter of 2021. So let's get started today. Let's talk about 457 plans and how to supercharge your retirement. This tells you who we are. We are what's called an independent registered investment advisor. We have a tremendous amount of experience working with municipalities in all facets of pensions. We do defined benefit pension plans. We obviously do 457 plans that we're going to talk about today. We do DROP. We also have a product that we do for larger municipal pension plans called RFP Referee, where if your plan is over $10 million, we help your township or municipality go out and look for consultants that are going to help to run the pension plan. So we have a tremendous amount of experience. Again, we're what's called a registered investment advisor. That's going to be very important when it comes to 457 plans, and I'll get into that in a minute. What's a 457 plan? So sometimes I hear this term thrown around that it's a deferred comp plan. It's really not a deferred comp plan. It's a way to defer your compensation, but a 457 plan is what they call a non-qualified retirement plan. So if you were working at a company, you'd have a 401k. If you were working at a hospital or a non-for-profit, you'd have a 403b. Because you work at a municipality, it's called a 457 plan. That just happens to be part of the IRS code that addresses it. Now, there's some cool things about 457 plans that are not available to 401k plans, and we'll get into that in a minute. But why would you want to do a 457 plan? The biggest reason is it's your number one way to save money on your taxes. I had a police chief a couple of years ago. We ran the 457 plan for their particular municipality, and he saw me one day and he's like, Chris, I'm getting killed on taxes. What am I supposed to do? And I knew how much he was putting in his 457 plan. I knew he could max out his 457 plan. I said, hey, why don't you max out your 457 plan? He was over the age of 50, so he could put $26,000 pre-tax into his 457 plan. Well, guess what? A year later, I saw him at the station. He's like, I can't believe it. My wife can't believe it. We saved a tremendous money on our taxes by putting money into our 457 plan. So if you're a police officer and you're making $75,000 a year, and you put $5,000 into your 457 plan, your W-2 is going to show $70,000 a year. So that $5,000 you put in your 457 plan is going to save you anywhere from $1,500 to $2,000 a year in taxes. Now, the other big advantage is it grows tax deferred. So it's better to make 6% on top of 6% on top of 6% than to pay the taxes, make money, pay the taxes, make money. So it's really a way, again, to supercharge your retirement. If you remember our first webinar series, we talked about your defined benefit plan. You then have your drop. Well, now you can supercharge your retirement by having your 457 plan. So these are pre-tax deferrals. Now, one of the questions I get is, hey, Chris, should I do an IRA or should I do a 457 plan? Well, if you're a new police officer, it really depends upon how much you're going to put in. Now, sometimes as a new police officer, if you're only going to put in $1,000 or $2,000, you may want to put it into an IRA. However, the big benefit of a 457 plan is you can put a lot more money into it, number one. Number two, depending upon your income, and if you're married, your joint income, you may be limited as far as the deductibility of an IRA from your taxes. So many times I get people where both the husband and wife are working and they have income of $150,000 to $200,000. At certain income levels, you lose the deductibility that you have in an IRA. That's why a 457 plan makes so much more sense, that no matter what your income level is, you can put money into a 457 plan and do it pre-tax. So that's probably the biggest question we get quite a bit. You can see the age limits. If you're under age 50, you can put 19.5. If you're over age 50, you can put 26,000. Now, I can tell you several stories about young officers that sign up for the 457 plan. They're 24, 25 years old. And they say to me, how much can I put in? I'm like, hey, you can put in 19.5. And they'll say, well, I'm living at home. I have a situation where my bills are really low. What if I would put 10,000 or 15,000 a year in my 457 plan? That is huge, because what you're doing is you're front loading your contributions literally for the next 25 or 30 years. Now, I do a lot of talking all the time, and we retire a lot of police officers, and literally the conversation goes like this. They come in and they say, well, Chris, I've got my drop, I've got my 457, I know I got to roll it over to an IRA, can you take a look at it? And I go over their 457 with them. Literally every officer says the same thing. I wish I would have put more money into my 457 plan when I was younger. So in our book that we have, I have a chapter for young police officers showing that if you put a nominal amount, $4,000 or $5,000 a year into your 457 at an early age, how much you will have literally when you go to retire. So that's how you can supercharge your retirement. Now let's talk about 457 plans and really where they are. And unfortunately, 457 plans have been kind of held back over the last 10 or 15 years. There's been some huge advancements in the 401k world. We're beginning to see that happen in the 457 world, but I'm still fighting quite a bit with people that don't understand that 401ks and 457s are virtually the same thing. One of the things that we see in the 457 world is we see a lot of insurance companies that offer 457 plans. And one of my pet peeves is, at our firm, we run 401k plans and we run 457 plans. We run them exactly the same. If you have a 401k, the 401k Department of Labor rules say that all fees and expenses have to be disclosed to each participant. So when somebody has a 401k with us, at the end of the year, their $100,000, it is broken out how much they paid in fees and expenses. In the 457 world and the 403b world, that does not have to be done. It can be hidden out there, and we really think that that's a tragedy for most 457 participants because they don't know how much they're paying. So in the 401k world, over the last 15 years, we've seen the movement towards low-cost index options, the use of investment models, the disclosure of fees, plan benchmarking, etc. But 457 plans and 403b plans have been kind of held back by that. In fact, we got excited about 5 years ago. The Department of Labor went out and said, hey, we want to make all of these deferred plans exactly the same. And they did a big hullabaloo about it. And we thought that finally what was going to happen was that participants' fees were going to be disclosed to 457 plan participants. Well, lo and behold, they asked for comments, and all of the big insurance companies, who are obviously big lobbyists on Wall Street, came back and said, oh, no, we don't want 457 plans or 403b plans to be like 401k plans, because that means we'd have to, they said, well, we're not up to speed on being able to disclose all the fees and expenses, which we all know is hogwash. They just didn't want to disclose them. So we have looked at many 457 plans, and many times you see the fees to run the 457 plan are literally double what they were if it was in a 401k plan. So how do you find out how much you're paying in fees in your 457 plan? It's going to be a challenge. It's going to be very difficult for you to find out. If you are the plan sponsor, i.e. the municipality or the township, every year you get a plan sponsor report. That plan sponsor report tells you how much money is in each of the investments, how much are the fees that were paid totally by the plan, etc. I have seen those reports, and they're very, very difficult to get. If you call up many of the major 457 plan providers as a participant and say, hey, how much am I paying in fees? They won't, or they can't tell you. They refer you to the prospectus. I have read numerous prospectuses in my career. It's very difficult to figure out how much you're paying in fees by just the plan prospectus. So unfortunately, that's the bad thing about 457 plans. It's very difficult for you to figure out what your fees are. We do believe that plan costs do matter. And here's a spreadsheet that shows, not that big of a plan, that it is not unusual to see 457 plans with total expenses, custody, advisor fees, investment fees, north of 1.85 to 2.5%. I can name you some of the highest 457 plan fees that we've seen. So here's an example that if your plan has an expense ratio or all in of 1.25%, which is how we run our plans, you can see that over 20 years with a participant plan of 40 participants, that the average participant over a 20-year period of time could literally save $17,000 in fees. So, the real question is, hey, you ask your municipality, your township manager, your borough manager, hey, we've got a 457 plan. Does anybody know what our expenses or our fees are? I can tell you it's going to be very difficult for them to find. However, rest assured, we've examined many of these plans, and the fees and expenses are much higher than what people realize. So what do you do? Well, here's what's interesting about a 457 plan. We handle a lot of 457 plans, and so I'm going to give you a little bit of a take on it. In a 401k, if I go into a company, I've got to literally replace the current 401k provider. You can only have one 401k provider. If you go into a school district, many school districts have 8 to 12 different 403b providers. If you go into a municipality, most of them have one 457 provider. We always think it's better to have some choices, maybe 2, no more than 3. But the unique thing about a 457 plan is that you don't have to do an RFP. Unlike your defined benefit plan that's covered under state statutes where you've got to do an RFP, you don't have to do an RFP. But the one thing that you have to remember is that you as an individual police officer can't call up your human resources department and go, hey, we really like Chris Engelbert Financial Advisors. We want to be in their 457 plan. The 457 plan has to be sponsored by the municipality. Many times when we go into a 457 plan, we ask for the plan document. And what happens is it's a vendor supplied plan document. So what it says ICMA 457 plan. You should never have a plan document that says the name of the company, because what ends up happening is they're trying to just have that particular company be the only 457 plan provider. That's a bad idea, because if that 457 plan provider gets sold, changed, etc., you're basically stuck, obviously, with that 457 plan provider. A 457 plan document is sponsored by the municipality. So it should say XYZ Township 457 plan for, and it should cover all of the employees in the township. We had a situation where we went into a borough and the police didn't have a 457 plan. Only the non-uniform had a 457 plan. Well, if I had time to go back to school and become an attorney, I would have taken that case on, because you cannot offer a 457 plan to one group of employees at a municipality and not another group. So what ended up happening? The police ended up saying, we want a 457 plan. We got the borough to sponsor, this particular XYZ borough 457 plan. It's open to everybody. And lo and behold, many of the non-uniform people have switched over to the 457 that we happen to be running. So what does it mean as far as cost to the employer? Well, a new plan document can run anywhere from $750 to $1,000. Now, last year, because of COVID, there had to be some upgrades and changes made to 457 plan documents because there's some ways you can take money out that weren't available before. your plan document should be updated. If it's not, maybe it's time to get a new plan document that gets adopted by the municipality. But the plan document will cover whether or not your plan, you're allowed to take loans from the plan. It covers who's eligible in the plan, full-time or part-time employees. We're seeing a lot of situations where we have one municipality that has a lot of part-time employees that are seasonal, that keep coming back every year, and they want to be covered by the 457 plan. We have another municipality where the township supervisors get paid a couple $1,000s a year to be township supervisors. They don't really need the money, but they're included in the 457, and they defer their stipend that they get for being a township supervisor into the 457 plan. So to set up a 457 plan is extremely easy. There's little or no cost to the employer. Basically, when we come in as an alternative for a 457 plan, we do a lunch with all the employees. We're saying, hey, we're going to be another option that you can have for your 457 plan. We do one-on-one participant meetings. We handle any of the transfers. There is no taxation to transfer from one 457 plan to another. However, depending upon who's running your 457 plan, there may be some charges. So, for example, in the central part of Pennsylvania, there's one particular company that will remain nameless that has probably one of the worst 457 plans I've ever seen, where every participant in the 457 plan, when they're making contributions, there's a 7-year back-end sales charge attached to each of the contributions. So you could be a police officer for 20 years and make a $1,000 contribution in 2021, and you're still under that 7-year declining back-end sales charge. It's a very, very poor 457 plan. Just as a side note, most of the 457 plans that we see or we deal with, and obviously our 457 plan, there's no back-end sales charge. How do you get around that back-end sales charge? Well, when you're done as a police officer and you roll over to an IRA, even with this, very poor 457 plan, they will not charge you when you are terminated and roll over. So one of the things, if you remember what I had to say, was the fact that we are a registered investment advisor. So what that means for you, we can give not only advice at the plan level to the municipality, but we can give it to each individual participant. So unlike other 457 plan providers, if you call them up and go, hey, I'm Chris Engelbert, I'm a police officer in XYZ Township, and I have $200,000 in my 457 plan, I'm a little scared about what the stock market's going to do. What do you recommend? They cannot tell you. As a registered investment advisor, those are the conversations we have all the time. So that's the difference between a registered investment advisor who runs a 457 plan and one who's not. Now, if you're one of those people that picks your own fund and does your own thing, may not be as valuable to you, but what we're seeing is that we're seeing 457 balances get very, very large. $200,000, $300,000, $400,000, $500,000 is not unusual. And what you should really do is you should have some professional investment advice. One of the questions that we get quite a bit is, hey, should we take a loan? Or, some municipalities allow loans from their 457 plans. Others do not allow loans. Now, who sets that? That's set at the township or the municipal level, whether or not they're going to allow a loan on a 457 plan. We have mixed feelings about it. If you're taking a loan from your 457 or your 401k, it should be the last place you go to take a loan. Because what people forget about is that if you take a loan, and typically you're allowed to take 50% of what your current balance is. So if your current balance on your 457 plan is $50,000, you could take $25,000 out, and you typically have 5 years to pay it back. The problem with that is that you are paying it back with after-tax dollars. So if you remember at the beginning of my presentation, I talked about how you're putting money into a 457 plan with before-tax dollars. What ends up happening is that if you take out a loan, you're losing that tax-deferred advantage. So what you're doing is you're paying taxes on your money, and then that payment that goes back to pay back that 457 plan, ends up with after-tax dollars. Now, if you would ever leave employment, that loan becomes due immediately. And what happens if it becomes due immediately and you can't pay it back? It's then included as income for the year that you left. So let's say you left this year and you had a $20,000 loan and you left your municipality. That loan, you've already taken the money, you've already spent the money, but now you're going to pay that as taxes next year on your income. And so that's one of the things that, people don't understand. And we try to counsel them that this is the last place. If you need the money, take the money. But we have a situation, every once in a while we run into a situation where we have a police officer takes out a loan on his 457 plan, pays it off, takes out another loan. Well, the problem with that is maybe you should not be taking out a loan, and maybe you should be looking at other ways to keep your leverage or debt down, which we talk about in our book. The other thing that people don't think about is they don't think about the loss in investment costs. So last year, even though it started out horribly, was an extremely good year in the investment markets. We had 457 plans end up anywhere from 20 to 25% total return for the year last year. So imagine if you had $50,000 in your 457 plan, you took $25,000 out. Well, you only made 20% on the $25,000 that you had left. You didn't make the 20% on your full 50,000. So you lost investment and opportunities, that most people didn't, realize, and it ended up becoming a very expensive way to take a loan. So if I sound like I'm down on taking loans from a 457 plan or 401k, absolutely, it should be the last place you go. Let's talk about some advanced concepts. So when I talk about advanced concepts, we do this all the time. There are a number of strategies that you can utilize in your 457 plan. So we've done this many, many times over the years. So many times a municipality, when you're at the end of your career and you're getting ready to leave, they give you one lump sum check for vacation, sick time, longevity bonus, etc. We have one township where a couple of years ago we became the 457 plan provider, and there was a detective that was getting ready to leave. And he's like, oh yeah, I'm going to be getting a check for $75,000. I said, have you been doing anything in your 457 plan? No, haven't done anything. I'm like, well, do you realize that at the time you could only put in $25,500? I said, do you realize you could take $75,000, put $25,500 into your 457 plan, roll that over to an IRA, and then you're not going to get hit with taxes. He's like, I don't know about that. And he was so busy running out the door, he didn't do anything. Well, the next detective who was running out the door a couple of weeks later, this first detective came back and said, oh my gosh, I got crushed on taxes because they gave me a lump sum check of $75,000 and I paid over $40,000 in taxes. So remember, when you get these big lump sum checks, it runs through the payroll grid, and the IRS thinks that you make that money all the time. So they give you a 50-55% tax rate on that check is what they end up doing. So if you can take some of that check and jam it in your 457 plan, you're literally leaving. You can now roll that 457 over to an IRA, and you will literally save yourself $10,000 to $15,000 in taxes. So we had a situation where we had a municipality that did the lump sum payout, and they were able to do a side letter. The police union was able to do a side letter with the municipality and said, hey, rather than pay us this lump sum payment, we know this officer is in the drop, and why don't we take that lump sum that you're going to pay him and break it up over a 3-year period of time and put $25,000 a year of that longevity, sick time, vacation time check into the 401k, or excuse me, the 457 plan. So he's been putting $26,000 a year into the 457 plan and literally sheltering all of that money from the IRS. Now, one thing you'll hear me say all the time is evading taxes is illegal, avoiding taxes is perfectly legal. So if you're at the end of your career and you're looking at a lump sum check the day you walk out of retirement, make sure you talk about putting money into your 457 plan. Now, you got to let your payroll department know about that ahead of time. You can't have them pay you the check and then go back and say, hey, listen, I wanted to put some of that in my 457 plan. They can put lump sums in your 457 plan. So my second bullet point is this incredible tool that's out there. So let's say you've been bopping along, you haven't been really paying attention, and you've been putting a minimal amount in your 457 plan. Well, the IRS allows this crazy thing where you're allowed to, the 3 previous years before your retirement, you're allowed to defer a maximum of $39,000 a year. So if you are in a 4-year drop program, the year before your last year in your drop, those 3 preceding years, you could put $39,000 a year into your 457 plan, and then the fourth year you can only put $26,000. It's a special provision in the IRS tax code for 457 plans. We have used this with other officers because, for example, an officer at the end of their career, they're working, their wife's working, they're really having a maximum amount of income, and they're trying to figure out how to shelter as much income as they possibly can. So remember, everything always ends up in an IRA. You do not want to leave your 457 plan behind. I think we have a great 457 plan. We have a lot of really good investment options in our 457 plan. But if you roll over to an IRA is like an empty glass. You can put any investments you want. You can buy individual stocks, you can buy individual bonds, you can buy mutual funds, you could buy bank CDs. Literally the sky's the limit in an IRA. So typically we end up seeing people roll their drop money over to an IRA and roll their 457. Now, in my career here, we've retired over 300 police officers, and we put about 135 police officers through drop. It is not unusual between the drop and the 457 plan to see police officers roll over 300, 400, 500, 600, 700,000. The biggest one I've done so far has been about 800,000 between drop and 457. And I know there are officers out there in the next couple of years that we will see a $900,000 to $1 million rollover from their drop and from their 457 plan. We have officers where we handle the 457 plan that have been maxing out and literally have $500,000 to $600,000 in their 457 plan. So it's not too late if you're not being aggressive with your 457 plan. But think about it this way. You're an officer, you get your defined benefit pension at age 60 years old, you're living off of that, you roll over $800,000 or $900,000, you can literally take another $30,000 or $40,000 a year out of your IRA to live off of, and literally have a giant IRA that you're helping to live off of. We're doing it all the time. So just to give you a little pitch on how we do our 457 plans, again, I talked about the fact that we are a fiduciary. Many of the 457 plans we see out there have no fiduciary. So what's so good about being a fiduciary? We've got to do the right thing for the plan. We've got to make sure that the fund lineup is good, that the fund costs are low, and that people are doing the right thing in the plan. Participants have direct access to us. We give out our cell phone number. I have officers call me all the time. Hey, Chris, can you look at my 457 plan? What am I doing? Am I saving enough? Am I not, I got a couple more years for retirement. Should I make some changes, et cetera? Again, you're not getting an 800 number when you're calling us. You're getting actual people. We do a lot of meeting with 457 participants, one-on-one meetings. Everybody's situation is different. Again, I told you that we've retired over 300 police officers. I can show you the good, the bad, and the ugly. A lot of police officers have other personal assets that we end up managing for them, in conjunction with their 457 plan. And then when they roll it over, they've got an IRA. So we have a lot of experience, working with police officers. We also have some unique ways that we talk to you. Many of you that are watching this webinar, if you would like, doesn't cost you anything. You can download my app for your cell phone. I have my own app. If you text Chris E, CHRISE to 36260, you can download my app. Why do you want to do that? Well, you can contact me. We have a lot of videos. So if you want to know what's going on in the investment markets, we do a monthly update, a weekly update as far as what's happening with the investment markets. If you are in one of our 457 plans, on the second page of my app, you can actually access your 457 plan. If you happen to have a personal account or an IRA with us, you could access that as well. So feel free to sign up for my app, try it out. We also use a personal video messaging system. Every quarter I send out and I talk about what's going on out there in the 457 world as far as what's happening with the investment markets. If you were, one of our participants last year, and obviously the market sold off extremely aggressively, we were telling everybody to hang in, and sure enough, people had a very good experience. So, I'm going to stop sharing my screen here in a minute and take on any questions that people have. But again, what we're going to be doing is taking this educational video on 457 plans, posting it to our website, along with the other 2 videos that we've done on defined benefit plans and drops. And again, if you've registered for the first time, you're going to be getting a copy of my book, Financial Planning and Retirement Strategies. I have chapters in here that show a young police officer deferring money into a 457 plan, a police officer in the middle age of their career, and also a police officer at the end of their career. So it's something that you're going to be able to take back with you and use it as a strategy to help supercharge your retirement. So I don't see any questions up on the board right now. Oh, did I say that? And there we got one. Here's a question. If I'm going to enter the drop in May of 2021, then I have 4 years of drop after May of 2021. Can I enter the 39,000 into my 457 plan in both 2021 and 2022 when I cash out my time off accruals? That's a really good question. I'm going to go back to that slide that shows that. So what ends up happening is the very last year that you're in the drop or you're going to be a police officer, that's the year you can do 26,000. The 3 preceding years, you can do 39,000. So what you're going to have to do is if you have 4 years of drop, you are correct. So you're going to be done with your drop. You're going to start your drop in 2021. You're going to be in 2022, 2023, 2024. So what's going to happen is that you can put the $39,000 in. Now, the only caveat that I say about that is it is also dependent upon how much money you've been currently putting into your 457 plan. There's a worksheet on the IRS website. And if you want to contact me directly, I can help you work through that worksheet because putting the 39,000 in, the cleanest way is if you haven't been making any contributions to your 457, God forbid. The cleanest way is the 39,000 goes in each year for 3 years, and then the last year 26,000. But if you've been making some contributions, that 39,000 could be reduced, by some amount. So there's a worksheet on how to do it on an IRS website, or we could help you with that. But yes, you are on the right track as far as deferring as much money as you possibly could into your 457 plan. So that's a very good question on that. I don't know if anybody else has any other questions. One of the other questions that we get quite frequently, and this goes back to the drop situation, is what happens when you enter the drop is that your contributions to the defined benefit plan should stop, your member contributions. And those member contributions are anywhere from 1% to 5%. Most places that you're maxed out at 5%. Those member contributions stop. So we tell many officers that, hey, that 5% member contribution that just stopped, guess what? You should be putting that money into your 457 plan to help, supercharge and help make your 457 plan grow. So it's a common question. You're getting ready to go to drop. The 5% member contribution goes away. Take that 5%. And if you're not, maxing out your 457 plan, or if you're only putting in a certain amount, you can now afford to put in an extra 5%. So if you're making 100 grand a year, it's an extra $5,000 that you can put into your 457 plan. Now remember, when you're done with your drop and your 457 plan, everything rolls over into an IRA. So what we do in our shop here is we run many drop programs and obviously many 457 plans. And let's say an officer ends on May 30th. Typically what we end up doing is about a month before they're officially retired, we sit down with them, we open an IRA. We happen to use TD Ameritrade as our custodian, very good custodian. So they open an IRA. Then when they're done on May 30th, we start to process the paperwork on their 457 and also on their drop. Typically within a week to 10 days, no longer than 2 or 3 weeks at the most, that money is rolled over into the IRA. Now, once it's in an IRA, you now have access to it. For example, this morning, I had a conversation with a retired police chief who was looking to upgrade his bathroom, and he needed some money out of his IRA that we happen to have been managing for the last 5 years. So we were having a discussion about the timing, how much tax withholding, et cetera, that you can do. So everything ends up in an IRA. Once you take the money out of an IRA, it's taxed as ordinary income. Now, one of the things that a lot of people don't realize is that if you're law enforcement from the age of 50 to 59 and a half, you do not have to pay that additional 10% early withdrawal penalty. They changed that law about 5 years ago. Many CPAs don't know about it. we have the IRS regulation that shows if you're a first responder, law enforcement, you don't have to pay that 10% early withdrawal penalty tax. But the reason why I say this is many times I get police officers who retire and they're like, hey, I want to take out 50 grand or 75 grand or 100 grand. I've rolled my drop over. I rolled my 457 plan. I want to take out $100,000. I'll be like, whoa, wait a minute. It all depends upon the strategy you have as far as your total income goes. So if your income is dropped because now you're on your defined benefit pension, taking out some money won't change your taxes that much. But if you take out a large chunk, like $100,000, that looks as if you made an extra $100,000 that year. And if you didn't do any tax withholding, you can pay a large tax bill the following year. So it's not that you can't take money out of an IRA. You just got to be smart about it and have a strategy on how you're going to do it. We do this all the time. We have many retired police officers who've rolled over their 457 plan into IRAs. And we talk to them all the time about, hey, maybe they need an additional monthly income, or maybe they're looking for a lump sum. What I always tell officers is the best thing about obviously being a police officer is that you retire early and you get a defined benefit plan. But the problem is you retire early. And so if you take your drop in your 457 and roll it over to an IRA, if you can manage not to touch that for a significant period of time, maybe 5 to 7 years, maybe even 10 years, that IRA is going to grow dramatically, and you'll be able to then take off more money at some point in the future. Many police officers we deal with, they retire early, they go get another side gig. And what we have them do when they get another job is, if it's at another municipality or if it's at a private sector company, we tell them put money into, if it's a private sector company, 401k, put money into the 457 plan. And then when you're done working, roll that over and add that to your IRA that you currently have. So that's a strategy we do quite a bit with officers. I'm going to wrap it up here. I don't see any more questions on the board at this time. Again, anybody that's signed up for this video, if you couldn't attend it live in person, we're going to be sending out the link. Feel free to share this link, this video with others out there. Again, we're going to have this on our website. And we really appreciate all of you for being on the webinar today. And we really appreciate all of our clients. And thanks very much. And we hope to talk to you soon.